Fed, explain what that would do.
Well, first of all, I think that he should. Will he? No, I don't think he will, but I wish that he would. He has to make some explanation as to why the Fed's balance sheet has been rolling down as far as it has for the course of the past 3 years. That's the damage that has been wrought. It's not the fact that interest rates have been moving up. It's the fact that the Fed's balance sheet has been rolling off. And Powell needs to make the statement that this is going to stop. But he can't, because the president has made it impossible for him to do so. If the president would keep quiet for 24 hours or 48 hours and stop haranguing the Fed, perhaps we'd have some action on their part. But they can't take action right now. Otherwise, it looks like they're bowing to the president's whim, and therein lies the problem. So we have a stock market that's under duress, and it's going to continue, I'm afraid.
You believe the chairman of the Federal Reserve, Powell, is endangering our entire economy, the stock market, and the well-being of Americans because he doesn't want to look like he's being punked by the president?
I'm afraid that that's true. The Fed has to maintain its independence. If the president would remain quiet and not be as vocal with his opposition to the Fed's raising of the overnight Fed funds rate, you'd give the Fed the ability to act. But right now, the Fed doesn't have that ability, and I'm afraid that that's the position that they've been put in. Sad, but true.
John, what are your thoughts?
My thought would be that we do have precedents where, amid a strong economy, the Fed went ahead and cut rates because of financial market instability. 1998, the Fed cut rates when the U.S. economy cut rates. Cut rates.
What
yes,
about
they
raising
did.
Rates?
Yeah,
raising rates. Forget about it. That's off the table right now. Fed funds futures assigns a 20% probability to as many as a single rate hike, as much as a single rate hike in 2019. They don't see it happening. 1987, the Fed cut rates again in response to the stock market crash of October 19th, 1987. So there is precedent, and we could go ahead and have Powell cite what happened in the past amid a strong economy.
No, but Dennis, that being said, you mentioned Powell. Every time that I've seen him speak, I watched that Dallas press conference. I thought was really telling because he admitted that he's not even sure what his policies are going to, the impact they'll have, or there's no instrumentation to tell him the impact they'll have 18 to 24 months from now. It seems like they're pleased that they feel like, $50 billion a month in accommodation pulled out of our economy has been working swimmingly.
Well, I mean, the economy has been doing quite well over the past several years, of course, and it's because of the expansion of the quantitative easing that began in 2008 and stopped in 2015. You had the fuel to sponsor for several years. You had the fuel to sponsor both strong economy and a strong stock market. Now that the fuel is being reduced, the economy can continue and may well continue for another couple of months to the upside, but you've taken enough fuel away that you can't sponsor both a strong stock market and a strong economy. We need to have the Fed come out and say, look, we have rolled off, or we've allowed the balance sheet to roll down through maturity of assets, and we're going to stop that process. Do I think that's going to happen? I wish that it would. I hope that it shall. I'm afraid that it won't.
Well, and of course, I think we all can acknowledge this all is a grand experiment. We've never been here before. And this is one of the things over the weekend, Treasury Secretary Steven Mnuchin, so he calls up these big banks, and he's discussing liquidity. I guess the idea perhaps was to trigger some sort of calm. It didn't do that. Here's what Kevin Hassett had to say about all of it. Roll tape.
Secretary Mnuchin is in constant contact with the financial community. He's friends with most of those folks. He himself operated in that space. And it's very normal for the Treasury Secretary to call people up and say, hey, how's Christmas looking? They've got credit card data. How are sales going?
But to say,
and
hey,
also,
do you guys have
any problems?
All right, John, listen, Hassett he wasn't going to go there. He wasn't going to touch anything with respect to the Federal Reserve. He eventually acknowledged higher rates at some point could really hurt the economy or hurt the slowdown. I'm concerned about these banks. Coming into the week, Goldman Sachs was down 37% this year. Goldman Sachs is getting hammered today. I'm not sure what's going on. Regional banks are getting hammered. They were supposed to be the winners this year. What's going on?
Well, we thought with improved capitalization, the banks were not going to be a problem moving forward. But according to the equity market, they are becoming a worry. And I think what we want to consider here, we no longer have a steep yield curve. We have a relatively flat yield curve that squeezes the margins, the profit margins banks get on loans. And there also appears to be some mounting concern regarding the underlying quality of the loans that these banks have provided. In some cases, they're loans to highly leveraged companies, junk bond companies, okay, the highly leveraged loan market, and perhaps in some cases, subprime auto loans, student loans, and the like. I want to add one thing on the corporate bond market. The month of December, we did not have a single high-yield bond offered by a U.S.-based corporation. All the high-yield bonds that we rated at Moody's in the month of December were, for the most part, from China, and we had one from the U.K. The last time we had absolutely no high-yield bonds offered in a single month, December 2008, which was right in the middle of the financial crisis.
Wow. Dennis, what do you make of this? It's just something doesn't feel right about all of this.
Obviously, Charles, it feels very, very bad. I trade only from my own account, so I don't run any other person's monies. I have a few millions of my own that I have at risk all the time, and I've been out of the stock market now for 6 months and sitting on the sidelines. The only thing I own are a few corporate bonds that I bought last week. I think sadly, I think this is going to get worse before it gets better. I think we're in the midst of a protracted bear market. And bear markets usually take us down 25 to 30% from the peak, and I'm afraid that that's where we're going to go. So, no, this does not feel good. Things are not doing well in Washington, D.C. Geopolitical circumstances that prevail are ugly. I'd like to be happier at the turn of the year, but quite honestly, I can't be.
Real quick, Dennis, we're running out of time, and I want to get you and John on this. Oil, you're known for your commodities investments. Yeah. It's up a little bit today, but we're talking $44 a barrel. A couple of months ago, we were talking about breaking out through 80 and going to $100. You bought some oil recently, I'm told. Do you think this is it? This might be the support point?
I bought a little sand. One of the users or producers of sand that are used in fracking, but that's probably 5% of what I own. It's nothing. The problem that you have to be, the thing for people to watch is what the term structure is doing in the crude oil market. And crude is bidding for storage. The deferred months and futures are well above the nearby futures. As long as that continues, and as long as that continues to widen, it is detrimental. It is bearish for the oil market. Is oil cheap? Yes, but can it get cheaper? I'm afraid that it can.
Well, that's for any asset class these days. John, what do you make of it?
Lower industrial commodity prices, oil, copper, and other industrial metals and lumber are telling me that the world economy is slowing down. If the world economy is slowing down, the U.S. economy is expected to slow. Corporate profits are expected to grow more slowly in 2019. Why are we talking about monetary tightening? Why are we talking about rate hikes? Why do we continue with quantitative tightening by the Federal Reserve, this release of tradable Treasury bonds into the